Well, welcome everyone. Thanks for joining us for today's webinar, where we're excited to review the results of our 2024 sales and marketing benchmark, our second annual one in an initiative we started last year. So today I'm pleased to be joined by our panel of two experts, our senior advisors here at Norwest. So Renee Cohen has been on the Norwest team for several years after leading marketing orgs at various technology companies. And I think most of you have probably met and worked with Renee, but Renee, if you'd be so kind as to
Sure.
introduce yourself to folks that haven't met you yet.
Will do. Happy New Year, everyone. Love seeing so many familiar names attending today. I see folks from within the Norwest portfolio and also some friends and thought partners that I know from outside the portfolio in the industry. And I've heard from many of you that you've been eagerly anticipating the benchmark report. So I'm really honored that you're here and joining us today. And as Ranjit said, I joined Norwest about 2.5 years ago as marketing operating executive, and I'm taking my 20 years of tech marketing and agency experience to support our 250 plus portfolio companies. And I started my career in growth marketing roles at Series A startups. I spent a number of years in a marketing agency where I developed B2B marketing strategies across a range of industries. And prior to Norwest, I was SVP of marketing for Lucidworks, which was later stage where I saw a scale of about 50 to 100 million in ARR there. And in my role here at Norwest, I'm part of the portfolio services team, and I'm one of two marketing operating executives. So Lisa Ames and I are here to be advisors and connectors to the CEOs and the founders and the go-to-market leaders in the Norwest portfolio. And I'm also really thrilled that our sales counterpart on the portfolio services team is joining us today. So David Rudnitsky, can you give an intro?
Fantastic. Thanks, Renee. Thanks, everyone, for joining us. Thoughts and prayers out for any of those in the LA area. By the way, you guys are experiencing some crazy times, but like everything else, hopefully get through pretty quickly. And I appreciate the time that you're going to dedicate with us over the next hour. I've been at the firm close to 2 years now. Like Renee, I see a lot of familiar faces, both in portfolio companies that I've been dealing with, as well as folks in the industry. My role is very different here than I've spent most of my career. Most of my career, I've been an operator. I've been very fortunate to be with the right companies at the right time and have grown up from a lot of the startup world, beginning with Netscape to Ariba, Salesforce.com, where I spent almost 13 years, to Yext, and had a very fortunate opportunity to help take 3 of those companies public. When I was done, I thought the next part of my career, I'd like to take what I've learned over all those years and share with a bunch of founders and startups. And I looked to join the VC world. I was fortunate enough to get connected with Norwest. And my role is to really, every couple months, take on several new portfolio companies and spend the bulk of my time guiding founders and head of sales or CROs in terms of testing their vision, really stress testing where they want to go, and helping them firm up the go-to-market expectations should be, what that motion might look like, et cetera. So thrilled to have you with us. We'll spend the next hour covering a lot of the great data that we uncovered through our cohorts. And with that, Ranjit, you want to take off?
Absolutely. I love that you both bring deep domain operating experience coupled with, over the last couple of years, more horizontal work across our portfolios. That's awesome. So let's get the party started. So what we'll be going through today is, first of all, we'll go through what some of the key challenges are that our respondents shared with us and what kind of growth trends they're seeing. Then we'll see how they're staffing and budgeting their marketing and sales teams to tackle those challenges. What are the metrics that they look at? How do they measure what's working and what's not working? Along with some very specific stuff around churn and customer retention, both operationally, what sellers and sales leaders need to do, as well as what marketing can do to help. And then we'll do Q&A. And before we head into the Q&A, we'll actually leave you with 4 very specific and very actionable takeaways. So excited to get started. Before we go into the data itself and some of our analysis, I wanted to share with you what the respondent data set looked like. So this was the scope of our data set. We got almost 200 survey responses, 195 survey responses ranging from pre-revenue companies all the way to companies at about 250 million in revenue. If we look at this last band, which is just greater than 100 million revenue, 50 out of the 51 respondents were at 250 million in revenue or below. The average of that cohort was 186 million in revenue. And then looking at the balance of were they responding to the marketing part of the questionnaire, the sales part of the questionnaire, or both, you can see that while there's a slight skew towards sales, it was a pretty balanced response, which is what we wanted to see. So that was great. And then here's how that distribution spread out across a couple of other dimensions. So VC backed versus PE backed, ASPs, as well as their planned annual revenue growth. And again, what we were most pleased to see was a relatively even distribution across all of those dimensions. So we're feeling good about the data set we were able to capture and analyze for you. So with that backdrop, let's start with the growth trends and challenges we're hearing about from our respondents. So in terms of growth trends, one of the key questions we asked is, what's the net new revenue target for your current fiscal year? And we broke it up, as you'll see, across those same revenue bands, which we thought were the best kind of cohorts to slice and dice the data by. And so what we saw is, as you can expect, is triple-digit growth in the earliest stages, going to 50% in the middle of the range, to 25% to 10% growth at over 100 million revenue. So kind of what we expected, and no big surprises there, but good to see that validation. And then to dive into some of the more interesting data that we captured, one question that we asked was, what would you describe as your company's top 3 biggest challenges impacting go-to-market and revenue growth? And what we saw was that there were a handful that were reported by both sales and marketing leaders. So positioning product as must-have, as well as differentiating in crowded categories. A lot of folks talked about longer sales cycles being a challenge, and that was borne out by some of our year-over-year analysis. And a little bit of foreshadowing, customer churn was the fourth one, which we'll get to actually in a little bit later in the discussion. So Renee, let's start with you about how one of the reported challenges was positioning solutions as must-haves and differentiating in a crowded market.
Yeah, and both positioning and even differentiation from competition, it comes back to telling a unique value story and addressing those two things, your positioning and your differentiation. Those are things that are within your control, while some of the other top challenges are really kind of an impact or a consequence of not positioning yourself effectively. So, for example, seeing sales cycles up here too as one of the top challenges, I really think that also really comes back to positioning, right? Because positioning your product effectively and really knowing your buyer and what their priorities are and being able to unlock budget for your solution, that really comes back to being able to position yourself effectively to get that budget approval or to get the full buying committee bought into your solution. And that's not just a marketing or even a broader revenue team challenge to address. So I know there are some CEOs and founders who are on the call today, and I want to challenge you to bring your entire leadership team together to solve for this. Your product strategy has to be opinionated as well for your marketing team to really deliver on that storytelling. And you have to be building product capabilities that are generating quick time to value, a strong return on investment, and stickiness in the workflows of your customers. And so in order to really deliver on that effectively, you have to know your customers really well. And so one of the things that I predict, and some of this is borne out in some of the additional data that we're going to share throughout the report here, but I think we're going to see companies shift to investing more in customer research, in win-loss analysis, in competitive intelligence, all of those things that you need to then feed back into your product team and your R&D team to start building for the capabilities that are really going to align to your ICP. And so your marketing team and your product team, they have to be in lockstep on the strategy. And David, I know you've got some additional thoughts to share on this as well.
Yeah, when you look at the top 3, the first 2 to me are really intertwined, and that's longer sales cycles and that must-have positioning. I'm going to speak about it a little later, but if you don't define your ICP and do the right due diligence and really understand what your customers want, and you lack that differentiation, it sounds pretty simple, And if you'd ask most sales leaders, they tell you they're doing it. But the reality is it's a really crowded market right now. And, this idea of, and I talk a lot about when I speak to our portfolio companies, this AI Me Too syndrome. You're going to lead with something that's based on AI. It's not unlike when I was at Netscape in 95, we would talk about the internet, and there weren't a lot of competitors back then, but we had to start to define what that meant. As I got to Salesforce and we evolved from on-demand to utility to cloud computing, every startup led with cloud. And the reality is you need to lead with what value you bring, what opportunities, what problems you're solving. Because today, everybody's saying AI, whether they have it or not, they're saying it. It needs to be part of what you offer. But I would suggest to you, which I coach a lot of our portfolio companies, particularly some founders, share with them, with your prospects, what value you're bringing and use AI as an enabler. So when you want to differentiate between a must-have and you want to try to reduce your sales cycles, it's easier than ever to start a software company. And so there's way more competition today than there's ever been. You have the dynamics of in office, out of office with COVID, stating the obvious. It's harder to get people sometimes. It's harder to walk the halls to really start to build real relationships. So think about that. The other one is customer churn. And I'm a big believer as you start to grow your companies, you've got to make customer success either your number one or your 1A value. And that's got to permeate through the whole organization. Everyone needs to rally around customer success and understand as a startup, you're going to redefine your ICP. There's going to be a lot of challenges, but at some point, you've got to stop the churn. And at some point, you've got to make customer success the number one thing that people focus on. If you're building the right products, you're solving the right problems, you've defined your ICP, it's inexcusable not to spend the bulk of your resources on customer success. Lots to figure out in a startup, but if you don't have the right retention and you start to have churn and it's a leaky bucket on the back end, it's really hard to grow your business.
Yeah, and we'll definitely be going into the churn and how sales and marketing can help address that particular challenge. Double clicking a little bit on the sales cycle length, kind of growing year over year relative to the results we saw last year, David. What's your take on it?
There's some interesting things, and when we went through the data internally at Norwest, I was a little surprised by some of the results, but we have a big enough sample size to take a look at this and try to figure out what's happening. But if you look at the average deal size and you look at the sales cycle in that mid-range where you're looking at, 25 to 100K in ACV, sales cycles and deal velocity has gotten worse. It's harder to sell. If you see the difference in the middle of the screen, in that mid-market area, we're seeing a lot of pressure on deal velocity, especially in the 50 to 100K band, where you're starting to have that as your ACV. And so when it starts to slow, you have to figure out what's happening there. Is it economic pressure? Is it competitive pressure? Is it sales enablement? But interesting, when you get past the high end, if you look at 100K to 500K or 500K and above, particularly in the 500K and above, take a look at the differentiation. Deal velocity is much faster in that 500K plus band. And so when you start to think about it, when you get to that enterprise sales motion, what we're finding, at least from the information that we got back from our polling, is that maybe sales enablement is built up better. Maybe the dependent roles that help sales be successful is built up better. Maybe at that end, you've differentiated yourself from your competition, but it's a significant change in terms of pace of deal velocity. So I would suggest, based on the data that we're seeing, if you're in those middle bands, particularly in that 50 to 100K band of ACV, you really need to think about stepping up your sales enablement, your competitive analysis, taking a look at your ICP. Are you chasing everything? Is that why sales cycles have been slow? Are you not able to differentiate yourself? So interesting data, certainly an area for improvement.
100%. Thanks for that, Dave. And so with those challenges kind of framing where we're coming from, let's turn our attention to how our respondents were actually budgeting and staffing their teams to tackle those challenges. So why don't we start first with you, Dave, in terms of how companies in these different revenue bands were staffing up their sales function. So their sellers, of course, but the rest of the staff that makes up the carrier group.
So as I mentioned, I've had a lot of experience in helping to take companies from nothing to something. And the challenge has always been, when do you hire? And learned a lesson from Mark Benioff many, many years ago. I started Salesforce our first year. The entire company did 23 million, and I left at 6.5 billion. And you see today with the numbers that Salesforce does, and they'll do well over 35 billion this year. And one of the things that we always paid attention to was continuing to build our distribution capabilities and looked at capacity and looked at productivity. And when you do that, it's not just hiring AEs, it's making sure that you hire all the dependent roles. And a lot of the portfolio companies I spend time with, we look at the ratios, because you want to make sure as you start to hire salespeople that they can be successful. They can't do it on their own. So there's some interesting tidbits of data here. I don't know how to explain it other than, as companies are growing, if you look across the line with the AEs, as they grow and they go from nothing to up to that band close to 50 million, they're significantly increasing their AE headcount. Interestingly enough, there's some pressure, and maybe it's pressure on all the investments they've made, all the money that they're spending, but that 50 to $100 million band, AE headcount goes down. So does SE headcount. And I'm a firm believer that you've got to have the right sales engineers behind any of the efforts in the customer-facing sellers who own a quota. The dependent roles, though, go up nicely. Sales enablement, rev ops, SDRs, BDRs. And then all of a sudden you have this dynamic where the companies that we spoke to, once you get over that $100 million mark, sales capacity kicks up proportionally much higher. Sales engineers go up. SDRs, BDRs go up. The one that I like to pay attention to is the sales VPs, because in my world, I've always preached an RVP or first line manager is the CEO. They own a franchise within your company. And it's up to them to be able to manage effectively. And it's really hard, particularly as you get to that $100 million and above, where you're selling much more in the enterprise space. You need to have some sort of rational ratios with the number of AEs to the number of first line managers. To me, in the enterprise space, it's 5, 6, 7, no more than that. It becomes much more difficult to manage complex sales cycles when you have more AEs than that. So you want to keep an eye on the ratios, but it's interesting in that 50 to $100 million range how it drops off.
Yeah, awesome.
So, the only suggestion I would say is take a look at where you're at. We have a good enough sample size to tell you what those ratios are, and kind of challenge yourself to see, are you sort of in one of those buckets, and how do you measure up to our respondents?
Yeah. And that was in last year's survey, one of the interesting things we found in marketing was everyone seemed to converge around a 50-50 split between the spend on human capital versus programs and technology. And that seemed to be like, if you were over-rotated in one direction or the other, you were either underpowered or weren't squeezing maximum, juice from the fruit in terms of the investments you were making. So I think these ratios should provide those guidelines for sales leaders. And then Dave, we found some interesting patterns that we weren't expecting when we saw when and where companies choose to expand globally.
Yeah, so when you look at coverage globally, not surprisingly, in the early days, what the data tells us, and it was no surprise to us, is that you're going to have initial coverage, obviously, in North America, and you're going to have it in EMEA. And that was what was expected. Around that $25-26 million range, all of a sudden, all 4 theaters kick in between North America, EMEA, APAC, and LATAM. The data that we looked at that was pretty surprising to us is that crossing that $100 million, that APAC LATAM coverage in theater, meaning in person, exceeded EMEA. Not sure how to explain that. I think all of us, when we looked at the data, were surprised about it. I can tell you that the one thing that I've seen work in the past at all the startups that I've been in is that as you start to expand your international coverage, and if you haven't started somewhere internationally and you have started your company in North America, a best practice that I've seen work might be you seed your international theaters with people from headquarters for a short period of time, bring best practices, bring culture, significantly reduce the learning curve. And everywhere I've been, we've taken top performers and they've done exceptionally well, taking short-term assignments, whether it be in Japan, whether it be in EMEA, whether it be in APAC, whether it be in LATAM, help seed it, help hire, instill that culture, bring a local flavor to it, and then have that lifeline, that umbilical cord back to headquarters.
Awesome. So now, Renee, let's turn things over to you. So here's what we found in terms of marketing budgets as a percentage of company revenue. And as we would expect, obviously, as revenue sizes go up, that the proportional budget, the percentage of budget goes down. But we saw some pretty startling things year over year. So yeah, what jumped out at you?
So this is one of the money slides that everyone asks for. So in fact, a few months after I joined Norwest is when I started collaborating with the team on launching our new benchmark process, because so many marketing leaders were asking, how much should I be spending relative to companies of my stage and size, and what should I be spending on? And in our 2023 report, one of our predictions was that we were going to see marketing budgets come down in this upcoming year. So it's not surprising to see that they have dropped year over year, kind of consistently across each of these different revenue bands. But to be honest, I was shocked at just how reduced they had become. And you can see, as I said, like each of these revenue bands, it has decreased year over year, but in that 25 to 100 million in revenue range, I was really blown away to see that they were reduced as much as 52% for those companies in the 50 to 100 million dollar range, and 43% in that 26 to 50 million dollar range. And we wanted to analyze this a few different ways just to understand what's going on here. So we had more PE-backed companies participate this year, and that was one question we had: is, oh, well, is it the PE data, making a year-over-year difference here? But actually, when we looked at the PE-backed and VC-backed companies, it was pretty consistent on the average marketing spend across the different cohorts. And in fact, VC-backed companies were even a little bit down compared to the PE-backed companies. We also looked at the Norwest portfolio compared to some of our external participants, and again, found budget averages were consistent. But what really unlocked, if we click over to the next slide, that kind of aha moment of what's going on here, we looked at growth rates in these cohorts, and we found a significant decrease in the planned growth for companies in these cohorts year over year. So in 2023, you can see 38% of these companies were planning to grow at least 50% year over year. And in 2024, that's dropped to only 9% of companies who are planning for that type of growth. And if we go to the next slide, I think there's a little bit more evidence from our survey report as to what may be happening here. We asked, and I'm going to actually have a guest speaker pop in here in a minute, but we asked our sales leaders to tell us if they had any material increase or decrease in their revenue forecasts in the last 12 months. And you can see overall companies were more likely to have increased their forecast if it changed at all. But venture-backed companies, it was significantly more likely to decrease their revenue forecasts and much less bullish on increasing them. And so I asked our head of M&A, Laura Boyd, to pop into the webinar today and help explain what's going on with this trend. And Laura, it seems like more venture-backed companies, particularly those who've raised maybe their last rounds in 2021 and 2022 in a very different funding environment, they might be feeling the most pressure here. And what are you seeing in the macroeconomic environment that could be driving that?
Great question. Hi, everyone. Happy to be here. I think there's a lot of trends that are driving this, but the one that we highlight most for our companies is stability. So venture-backed companies, especially those who raised in 21, are, as you all know, working really hard to grow into the valuations that they had set at that benchmark point. So what that means is that in a lot of cases, companies have grown significantly since that point, but they're not hitting that benchmark yet. And so what they want and what they need is effectively to give themselves optionality. And that takes the form of time. If you cut your burn, you have more time, and you have more time to decide how you're going to raise your next round, what it looks like, if you're going to pursue an exit, when that is. So a lot of companies are pursuing endeavors to lower their variable cost structure. So what that means is just cutting burn. And so if they think they can do that, a lot of VCs and investors and strategic acquirers are encouraging startups to find ways to be independent, not be dependent on that next round, not have to basically be pursuing that at all costs. A lot of versions of that take cutting growth in favor of profitability or pursuing profitability in the form of lowering burn. So I think a lot of it is just that stability point over and over is how much time do you have, how many options do you have, and when do you have to make choices?
Great. Thank you. And I think what that means for any marketing folks on the call is, especially if you're in a company that's kind of facing that decision, is it's a new reality. You are going to be doing with less, and that's going to change what your program mix looks like. And so building strategies that are more sustainable, have more organic growth that attracts your buyers, and doing less paid distribution. I think we're seeing that. And then we're also seeing that shift towards needing to emphasize nailing your positioning. And there are some additional trends that we're going to get into in the next couple slides around that. Thank you so much, Laura. Ranjit, if you go to the next slide, we see some of the headcount trends here for marketing leaders. We're not seeing, I just want to call out, not seeing a huge decrease in headcount across the board, but companies are reporting in some of these cohorts a fairly similar number of FTEs, but there are a few callouts in that 50 to 100 million range. So one of those cohorts that did have reduced spend on their marketing programs, we are seeing they have scaled back on FTEs, but they are making up for needs with fractional talent that allows them to scale up and down as things change. But for those companies, 66 million to 50 million in revenue, they're almost flat. And in some cases, maybe adding headcount here and there. But anecdotally, I have heard from companies who have restructured their organizations with more individual contributors, and that's bringing down the cost per FTE. And they've also experimented with offshoring or hiring in some lower cost of living regions. And so we've seen, when we look at those marketing budgets that have decreased in some of these cohorts, a lot of that decrease has come from the paid program spend and not quite as much on the FTEs, because folks are either keeping their teams flat, lowering their teams, or also maybe restructuring so that they can drive their cost per FTE down. And I want to also point out that companies 5 million and under have been much more conservative on hiring out and building their first marketing organization. And so I can say that's the right call at this time. Don't scale out your marketing team before proving out product market fit. We're seeing companies hire somebody who can be hands-on, get results in supporting your sales team to tell the story and operationalize your outbound and your go-to-market motion in those early days, so that you can get traction, get enough customers under your belt that you can then start really refining your ICP as you approach product market fit. And then on slide 17, we did ask one other question here around the marketing team makeup, and this was, what are you planning to hire for? How are you staffing in the next 12 months? And unsurprisingly, given what we heard about those top pain points, when we asked marketing leaders this question, product marketing was in highest demand. As teams have scaled back their paid program spend, they're looking to invest more in messaging and positioning, and that competitive intelligence and that audience research. And when you're spending less on distribution, you really have to nail your message, and you have to craft a story that's going to attract and draw your audience inbound. And then
I mean,
yeah, go ahead, Ranjit.
That probably goes hand in hand with the fact that most of our companies were reporting that differentiation, positioning, these were pretty key challenges, and that's probably shaping their hiring priorities for sure. Yeah. So, sorry, Renee, were you making another point?
Nope, no, go ahead. On to the next.
Okay. So then another interesting question we asked, obviously the age of AI is upon us. We are in it now. So we were curious how and where our respondents were using AIs and what kinds of use cases and what kinds of scenarios. And as you can imagine, not terribly shocking that it's across the board. Everyone is starting to dabble in or straight up start using AI in various different capacities, including many that we didn't have listed. But what was interesting to me was when we were doing our prep call, David, both you and you, Renee, had very yin and yang takes on what AI means for our portfolio companies. So maybe, David, I'll start with you first. What was your take as you were looking at the data here?
So the obvious one to me, and I mentioned it earlier when we talked about the challenges, you have this AI syndrome, right? So everyone's saying it. And what I coach our founders with and our sales folks is that you've got to be able to get through that and provide value. And then AI is the enabler. Now turn it the other way. You're now a buyer of these solutions, right? How do you sort through the noise and start to think about how you want to use AI to run your business? But in turn, it's a really good lesson for you to learn is that as you're seeing all these opportunities to purchase, to improve efficiency, productivity, is the message clear? And are you actually, using that same value statement when you're out there selling? Do people understand what it is you're doing in the world of AI? So the interesting thing is, if you look at the top couple of use cases, it's the most popular being used for content creation and brainstorming. No surprise. The third one, that automated SDR, BDR outreach, no surprise. We have some portfolio companies that do it exceptionally well, like Lavender and Qualified, where you have both inbound and outbound and using AI as the platform. So we think, based on the data we got back, 60% of the respondents are going to use all of these use cases or considering them. So it's going to be on your table as a buyer, and then think about how it is on your table as a seller. And Renee, there's a couple of really interesting use cases across the board with our portcos that you might want to share.
Yeah, you had already mentioned Lavender just launched, I think last week, Lavender Aura, which is an AI sales agent for outbound SDR outreach and Qualified. If you live in the Bay Area, you might have seen some of their outdoor billboards for Piper, their AI SDR, and that's focused on fielding, following up with inbound leads. Gong, another one of our companies, they have a number of AI capabilities threaded throughout the platform, and Gong Engage automates a number of the follow-up steps related to prospecting, pulling in that revenue intelligence to create that automation. And then there are some outside the portfolio with some really interesting use cases around ICP research, and then being able to take that and easily plug that into your AI generated content to do rapid and very targeted, precise personalization. And I want to give a shout out to Clay.com, which has been having a moment in the last year where a number of companies are finding it extremely valuable in building tighter audience segments and target account lists. And that's going deeper than your basic. Often when I ask a company to tell me who your ICP is, I get the very basic vanilla answer of, oh, well, we reach out to companies of this many employees or this much revenue and these industries, and that's it. But Clay allows you to get more sophisticated because they pull in a number of different data sources, and you can pull in, yes, some of those basic firmographic information, but you can pull in technographic information like the tech stack of these target accounts. You can get intelligence around their hiring priorities or their strategic initiatives or other qualities that make them lookalikes to your ideal customers that you've already sold to and proven you have valuable solution for them. And so you can then take that intelligence and create more personalized messaging, because Clay also has integrations with tools, with our solutions like Lavender, with Gong, with HubSpot, with ChatGPT, that can feed the unique characteristics of these companies to build outbound messaging that's tailored and personalized and deliver that in a much more personalized way in your outbound prospecting. And so as you explore how to integrate AI into your RevOps workflows and tech stack, those are some of the places I'd encourage you to start looking.
Yeah, and I would tell you as an ex-CRO, you can scale your sales enablement through technology easier than ever. And so even in a startup mode, as you start to go through those bands of revenue, you can start to build out a really, really world-class sales enablement team without over hiring by selecting the right technology. And I would tell you, as you start to add headcount, pay attention to the folks that you interview for these positions, their understanding of the latest technologies and how to take advantage of them. You can get scale on sales enablement faster than any of the supporting or dependent roles around sales. So use it to your advantage.
Yeah, it was really interesting to get kind of the, if you will, the sell side perspective from you, Dave, and the buy side perspective from you, Renee, in terms of how we can be thoughtful in consuming AI. So thank you both for that. So now let's take a look at how we're measuring some of our functions and what trends we're seeing in some of those measurements, what they mean. So this is a slide that's probably familiar to you, at least the format, if you looked at our findings from last year. So these were the top KPIs that marketing leaders reported as the ones that they focus on the most. And I think the most interesting thing that we saw was a general trend. If you look at the kind of hotspot where the dark greens are the ones that were scored most strongly. Overall, Renee, we saw this trend that everything was moving a bit down funnel. So that was certainly interesting. But what else jumped out for you?
Yeah, unsurprisingly, opportunity creation is number one, right? So I want to just calling that out. I think that's always going to be the case for most B2B organizations who are targeting the enterprise. In PLG companies, you're always going to see that shift further, especially in a self-service type PLG sale. That's going to shift further down funnel to actual closed won business. But in your sales-led motion, marketing is driving top of funnel to help build pipeline for your reps. But the surprising two trends that I saw is when we look up funnel from that, and so another term I like to use when talking about these up funnel metrics is the leading indicators of opportunity creation. We see that the second most popular KPI here beyond opportunity dollar amount was meetings. It wasn't MQLs, and I'm going to share a little bit more about that in a second on the next slide. But I want to also share that the third most popular metric was net new leads. And I think this suggests that marketing leaders are getting more strategic and moving beyond, evolving beyond the MQL to start measuring their revenue by looking at first, how, if we go higher up funnel, how much confidence do we have that we're penetrating our ICP? If you look at that net new leads metric there. This is sort of like a capture of market share, but think of it as mind share across your target accounts. So if you have, let's say, 2,000, just for easy round numbers, 2,000 target accounts in your ICP, are you engaging again and again with the same 500 accounts? Your database is kind of stale. You're not really getting in touch with net new accounts. Or are you demonstrating the form of net new leads that you are building awareness and engagement with those 500 accounts and 300 more of those accounts? And then secondly, our marketing leaders are skipping over the MQLs and reporting that they're the tangible meetings that they're driving that are taking place with those leads who are in your ICP. And if you go to the following slide here, we see that this shift is moving away from the traditional definition of an MQL. In 2023, most marketing leaders, more than half of them, used the old lead scoring playbook to define an MQL. So that was over 50% said they used lead scoring to define that. And I've been asked in my role here, what's a good conversion rate from MQL to opportunity? And companies frequently want this benchmark to use it as an up funnel metric to determine what marketing spend should be, to predict the opportunities that they'll be creating. And my answer has always been that anything surrounding MQLs, it's an impossible metric to benchmark because lead scoring isn't standard. It's a really arbitrary definition based on firmographic criteria. How closely does that lead match your ICP and their activity? And I've joked a lot that many lead scoring models, they will automatically MQL anyone who's in your ICP who like walks past your trade show booth. And that's despite maybe they've never heard of your company before that interaction, despite not having an open initiative where your product might be a fit, despite having no approval or timeline or any proof that they're in a buying cycle. And I think that has borne out in companies' confidence in being able to build predictable forecasting models from marketing through to sales. And so in 2024, we're seeing many marketing leaders report that they're ditching the old lead scoring approach. What we haven't seen here, though, is that there's a new standard approach that's replacing it. So we are seeing more rigor around ICP definitions. I think we're going to see people who are looking at the true universe of their target accounts and measuring their engagement within those target accounts, but then only starting to model revenue forecasts on more concrete leading indicators like the meeting. So you can see that some of those folks have shifted to a more strict definition of the MQL to be people who have asked for a meeting, asked for a demo. I think we're seeing that move to that more strict criteria of modeling your forecasts based on how many meetings are taking place. And I've seen just anecdotally in my experience in working with our companies, it's much more consistent. I tend to see about 50% of meetings within your ICP convert into opportunities compared to MQL conversion rates, which have been all over the place. And so I think that goes back to the importance of stability, which Laura had talked about in that trend towards stability, having more confidence that you're going to hit your revenue targets. We want to make sure that as companies are pulling back on marketing spend to reduce their cash burn, you also have to realize that anytime you miss your revenue number, that's also impacting your cash burn. So we need a more concrete model for measuring our conversion rates, and meetings through to opportunities just much more consistent for folks. And I think that's why we're seeing a shift away from kind of these more arbitrary MQL definitions.
I couldn't agree with you more. And if you think back, Renee, to our report from last year, one of the takeaways was the MQL is dead, long live the MQL, because it was still the #1 metric. And this year it didn't even medal, it didn't crack the top 3. So I think it's a trend in the right direction. So thanks for that. Now, earlier we talked about the fact that one of the challenges that all our companies reported, reported that we haven't double clicked on yet is customer churn. And that's where I'd like to direct our attention next. So Dave, starting with you, we did see a change in who was responsible for driving renewals. So what did you see in the data, and what are you hearing from your work with our portcos?
So, it's interesting. Some of my opening comments, I talked about, I suggest your #1 value or your 1A value better be customer success. And that means that it's everyone in the organization paying attention to it. There are renewals teams, there's customer success teams, there are sales teams, there are marketing teams. But at the end of the day, if you're a founder, you really need to instill in your culture, in your beliefs, and your values, that customer success is insanely important, and not just pay it lip service. So kind of some of the trends we're seeing, and you guys ought to think about how you're doing this in your own companies. Dedicated renewal teams that specialize in it are on the rise. And I would tell you, in the mid-market space, before you really get to the high enterprise, I'm fine with you building out a renewals team where it's highly transactional, but somebody wakes up every day and he or she is responsible for a set of renewals. And so that's on the rise. AE sales team engagement is on the rise, and I'll speak about that in a minute. The interesting data that we got, if you look at the middle column, is that dedicated customer support teams who are focused on renewals have significantly decreased, substantially decreased, where customer success is responsible for renewals. I've seen this model work in a lot of different variations, and the only thing that I can share with you is that the higher up those bands of revenue you get, it's really important that somebody owns that renewal. And I think for my world, I'd like somebody that's some sort of combination of whether they're on a renewals team, customer success, whatever group owns it, the AEs need to be involved. Because shame on an AE, if he or she sells a big deal, it's up for renewal maybe 12, 24, 36 months from now. They have no clue how well the customer's doing. They have no idea whether it's successful or not. They're completely surprised if the customer does not renew, completely surprised if they don't upsell at all. So in my world, an AE can never lose sight of the fact that that customer, the relationship started with them. But think about where you want the responsibility. Who wakes up every day and goes, on an org chart, you own renewals? It could be through customer success, although we're seeing a lot of our portfolio companies decreasing that dependency. It could be through this dedicated renewals. And my only guidance to you guys on that, if you do the dedicated renewals, at some point, there's going to be, you can't make it transactional at the high end. Somebody needs to own that relationship.
Fantastic. And Renee, as we turn our attention to marketing, what did you find about the programs that our firms are using or our respondents were using to keep that relationship with existing customers healthy and vibrant?
Yeah, I think the good news here on this is that everybody, or a fair number of more than half in some cases, half in other cases, are using a lot of these different tactics to help to retain their customers and drive expansions and NRR. And I think what we're seeing, what surprised me here was that most of the people who answered this question were using 2 or fewer of these tactics. And I think for the companies when we saw on the top challenges that most companies were saying that customer churn was one of their top challenges, I challenge them, why aren't you maybe doing a little bit more integrated work here and running more than 2 of these programs? And so going back to David's point that this is not just one team's role and sole responsibility, I think the entire revenue org needs to go and surround the customers and look at, hey, are we doing everything possible that we can? And are there more of these programs that we could be running across our teams? And CEOs and COOs who are leading their goal setting in 2025, they should set a shared net retention goal for the entire revenue function. I think that's going to ensure that their leaders are prioritizing the retention in the expansion programs like user groups, like cross-sell campaigns that do require cross-functional support to really pull those off. So I think that companies could be doing more here. I think there's some good stuff here that is that's happening, but I think especially if you're struggling with retention, this is something you really need to pay attention to and potentially be doing a little bit more.
Yeah, absolutely. It really is a team sport, I think is the point that I'm taking away from both of your kind of analyses and observations, which is 100% true. So thank you both for that. Our last slide is really what can we leave you with before we turn to our Q&A section. What are some concrete, actionable takeaways we could leave you with? So these were the 4 things that we thought would be most impactful. So David, I'll start with you first.
Yeah, and if I'm going to leave you with a few things, and I mentioned it earlier, when you have these challenges, longer sales cycles, how do you differentiate yourself, et cetera, you've got to nail your ICP. There is a tendency, and I've been guilty of it myself, chasing things that look great, and if most salespeople are optimistic, everything, if you're a hammer, everything looks like a nail. And the reality is, at a small company with limited resources, you can't chase everything. So there's this credo that I've always pushed for teams that have worked for me. You better know your customer better than they know themselves, meaning do the due diligence. Take the time to understand what are the problems, what are the issues, what can you help solve, where can you bring a real return to those customers? Because that will allow you to differentiate yourself, allow you to be more efficient. Laura talked about, where you might want to decrease spend, where you might want to slow down burn. You're still going to make investments, Knowing your customers better than they know themselves allow you to make those right investments. It's harder than ever to sell. It's confusing. It starts with understanding that customer base. The next one is something I talked about in a prior slide, which is you need to invest in sales enablement. And it is a combination of technology and people, but it is a very dependent role. You know, Ranjit just made a comment that we look at selling as a team sport. You know, I'll take it to another level. It's a full contact sport. It is not a spectator sport for what we do and everybody on this call. And what I mean by full contact is everybody gets involved. And that starts with training, enabling, rallying people around a message, understanding value, understanding culture, and then understanding that customer. How do you sell to the ICP, et cetera? It all ties into sales enablement.
Yeah, and I would add on through that thread is that product marketing investments are going to be key to understanding that ICP, being able to fuel your sales enablement and the education around the objections that your prospects might have around your differentiation. And one stat that we didn't highlight today on a slide, but I want to call out here, is when we analyzed companies with the highest win rates, they were investing more in product marketing. So we saw that the companies with the highest win rates had about one more product marketing team member on their team, FTE on their team, compared to those with lower win rates. And their paid program spend in designated towards the product marketing function and initiatives, that was higher as well. And so going back to those top pain points and solving for how do you tell a compelling value story that's going to unlock budgets, it's going to make you sticky within your customer, that goes back to these product marketing investments. And then going back to that stability piece, the other takeaway I'd leave you here with is forecasting with accuracy. On the marketing side, this means getting much tighter on your up funnel leading indicator KPIs and not using kind of broad definitions of what a lead might be, but really getting tight around your ICP and how you're penetrating into that ICP and how that is driving actual concrete tangible meetings. And then David, I know there's a lot that you would guide CROs on for forecasting.
Yeah, and for those of you on the call that might have heard me say this many, many times as I get engaged with your company, there is nothing more important on a first line manager than to own the integrity of a forecast. AEs own the integrity of the data that go into a forecast. First line managers, RVPs, own the integrity of the forecast. And I'll leave you with this. A forecast is important for so many different reasons, but one thing you need to share with your quota carrying folks, it's not Big Brother. In a startup world, if you look at those bands getting to at least 100 million, 100K or more, 500K or more, you need to make rational business investments. They're going to be guided by the forecast. And if they tell you what they think you want to hear versus what you need to hear, you can't make those rational business decisions. And they're going to want more product marketing, which Renee just talked about. They're going to want more field marketing coverage. They're going to want more dependent roles, sales enablement, sales engineers, customer success, you name it. Your CFO and your founder are going to make those investment decisions based on trusting a forecast and allowing them to spend money rationally, okay? And so it's important to everybody. For someone who's done pretty well in this industry, I am not technical and I'm not operational. But one thing I've never compromised on is forecast accuracy. And I can't implore you strong enough. Make sure that it starts at the ground up because that will drive the investments that you make and everything else follows suit. So with that, we want to give ourselves a little bit of time, one, to say thank you, and more importantly, to either answer questions live or through the chat. So I don't know, Ranjit or Leah, who's going to run the Q&A, but we want to leave ourselves a little bit of time to answer some questions.
So absolutely, I've got the questions coming in here, so I'll take us through the top two or three as much as time permits. So the first one, maybe since Dave was wrapping us up, I'll start with you, Renee. So one of the questions that had come in earlier was how to best attribute team contributions. So between sales, marketing partners, for complex enterprise sales. So attribution models,
Yes.
always an interesting conversation.
I don't think anybody has cracked the code on attribution. It is still in 2024, 2025 has been a little bit all over the place in terms of effort, and does the effort to implement an attribution model actually pay off in your ability to make better decisions? Oftentimes I hear it does not. For those who are trying to implement something like really quantifiable and systems based. On a principle level, one of the things that we leave our companies with when they ask about attribution is, why is this an initiative? And if it is around who's getting credit, oftentimes that's the wrong place, especially when you are talking about that complex enterprise sale where all of these things should be working in concert and touching most of your complex deals, especially enterprise deals. What you want to be looking at attribution for is, how do you make investments? Where are you going to lean in and invest? What programs are you going to invest in? Which partners are you going to lean in to do more with? Which sellers are actually driving revenue and driving business for you? And do you need to invest more in an SDR function, because that's going to drive the data showing you that's driving good outcomes? So that's the principle I'd leave you with as you think about attribution. And then from there are a number of ways to tackle it, but it really should be about, how are we going to make our investment decisions that should be driving that question.
Absolutely. So maybe driven as much by ROI as who's getting the credit.
Yeah.
Love that. So Dave, back to you. As a CRO, what are the top 3 metrics that will keep you up at night in 2025?
One ties in actually to what Renee just talked about. I hate a discussion around attribution. You need to measure it. But when we sit around the table, particularly C-level table, and we argue about attribution, it becomes more of a very selfish discussion. So for me, one of the things that keeps me up when I was running sales orgs, I would look at our pipeline coverage ratio down to the first line, down to an RVP level, because I want to understand where we need help building qualified pipeline. And a lot of it goes into what is qualified. And there's many definitions of what makes it qualified. But if you settle on what's qualified, where you have some opportunity in that given period to close business, then you start to look at your pipeline coverage ratios. And it's interesting because many times, Ranjit, particularly when you have a bigger company, you have to have and have nots. So you'll get this report that says, well, my pipeline coverage ratio is 4 times going into the quarter what my quota is, and it's qualified. And then you break it down, and it's like some groups have 7, 8 times. And then you have this poor RVP, he or she's looking at it going, wait a sec, my coverage is about 1 times. Unless I run the table, or unless there's some, discover and then close in quarter, I have 0 chance of making my number. So I care a lot about that. I care a lot about, if I'm running a company, what is it that I'm messaging out to the world? How do I differentiate myself? Okay. How do I take what I have, and 1, hopefully it's disruptive. 2, it's very clear what problems I'm solving. And 3, it's very clear how I differentiate myself. I worry about that a lot. And as I'm growing a company, I'm always paying attention to how can we be more productive, more efficient. And it'll go back to that simple slide we showed with all the dependent roles, where you're hiring, 80 hires come down. When it gets to that 50 million, it goes back up to 100 million. The reality is, I want to put a team on the field, and I use a lot of sports analogies, but I want to put a team on the field where I have enough protection for my quarterback, I have speedy wide receivers, I have great running backs, I have a team that can support the efforts. It is not just the salesperson. They may get a lot of the credit, but shame on that rep that takes all the credit themselves. It is a team sport, and I worry about, do we have the right dependent roles, sales engineers, etc., supporting their efforts? That's what I care about.
Yeah. And absolutely. And I think you'd probably agree that the best reps that I've worked with are always the first to recognize the team that helped them bring
Got
on
it,
the business.
100%.
So everyone, we are at time. There's several more questions that came in pre-reg and during the Q&A. So we will do when we share the recording, we'll try to do a recap of the questions and answer them either in the email out to you or in a blog we'll publish. But thank you all for your time and participation and engagement. And Renee and David, thank you both so much for our work together over the last many months on this and your time and analysis today. And Laura, thank you for being our pinch hitter extraordinaire from M&A. So thanks everyone. We'll wrap it up here.
Thanks, everybody.
Thank you, everyone.